This is Ty Crandall with Elite Credit. Thank you for taking the time to watch this webinar. In the next 15 minutes, I'm going to reveal to you the actual formula for the makeup of the credit score. And most importantly, I'm going to give you over 12 tips of things you can do to actually control your own credit scores. We have a lot of stuff to go over in a short period of time, so let's go ahead and get started. Your credit score secrets revealed. So, to get started, what is a credit score? Well, a credit score is a mathematical model used to determine credit risk. More precisely, it's actually designed to measure a consumer's risk of going 90 days late on a credit account in the future. Risk is then calculated as a 3-digit number between 450 and 850 in most credit scoring models. Now, there are many different credit scoring models that exist today. It's the first thing you're going to want to know. Most of these are designed by a company known as Fair Isaac, who has just recently changed their name to FICO. They're the company that designs most of these credit scoring models that are in existence today. The credit bureaus actually even have their own score model known as Advantage Score. Advantage Score is rarely used, but if you do pull your credit report from credit monitoring services that are owned by the credit bureaus, such as True Credit, you might actually see the Advantage Score go up. And the Advantage Score is one of the only score models out there that actually goes higher than 850. That score range does not go 350 to 850. It actually goes as high as 900 with the Advantage Score. There are also many other private scoring models that exist, even including a global credit score model, which is available for international credit. But most interesting to you is going to be the approximately 16 other industry scorecards that are in existence today. So, the credit scorecards, these are a very well kept secret. I'm going to show you how they work. Most major industries have their own scorecards, such as the auto industry, the mortgage industry, banks, even credit cards. And scorecards weigh industry-specific accounts greater into the total score. So let me give you an example of how this works. Let's look at a typical late payment, for example, on a credit card. So if you have a credit card and you have a beginning credit score of 650, one credit card late payment occurs, that might bring down both the consumer and an auto industry credit score about 30 points, maybe down to about 620. Now let's look at a car loan payment and how a late payment would affect the credit in this. Beginning credit score of 650, one auto late payment occurs. On the consumer credit score, again, it decreases by 30 points to 620. But on an auto industry score, the decrease is much more, about 50 points, lowering the total score to 600. What this means is if you pull your own credit report and you see this car late payment, you might see that your score is 620, and you might see that that late payment dropped your score by 30 points. But if you went into a car dealership, they might actually see that your score was lowered by 50 points down to 600. The reason is because the auto industry score they look at looks at your car loan history heavier than any other account type. Why? Because you're applying for a car loan and they want to look at your auto history heavier than anything else. So if you have a car late payment, it's going to affect your auto score more than it would affect your consumer score. What this means to you? It means you might be driving off the lot in this car right here. So, let's get down to the actual basics, the real secret of the credit scoring formula. The first thing you're going to want to know is all credit score models have the same 5 main score components. And that's what we're getting ready to look at. Right now we're going to take a look at the actual 5 components that make up the credit score and what you can do to improve your credit with each one of these components. The payment history accounts for the largest chunk of your credit score at 35%. The largest portion of your total credit score is made up of how you pay your bills, or 35% of your total score makeup. This is based on your prior payment history with your creditors. It's kind of a weights and balance of your good versus your bad credit on your report. Late payments, bankruptcies, and all other negative accounts reduce the credit score. Positive paid as agreed accounts increase the total credit score. Some tips to spike your score? Make sure you always pay your bills on time. On time or early means never be 30 days late. By law, a creditor cannot report you late unless you're 30 days late. But If you're going to pay a bill close to the due date, make sure you keep a record of when you pay the bill. A lot of creditors claim that they need 10 days to process your payment. So if you pay a bill that's due on the 30th, on the 28th, make sure you have a record that you paid the bill early so they don't report you late. If you are going to be late, call and ask them for a courtesy adjustment. Most creditors that you've had an account with for any given time will definitely issue you 1 to 2 courtesy adjustments where they'll give you some leeway time without you reporting you late to the creditor or to the credit bureaus. This is what you always want to try if you know you're going to be late. If you do have negative items that report to your credit bureau, you want to dispute those negative credit reporting items to have them deleted. Again, this portion of your credit score has to do with good versus bad credit. The fewer negative items you have, the higher your credit score will be. So by disputing and removing negative items, this is going to increase your overall score. Another thing you can do is add positive credit reporting items. We found a great $5,000 line of credit which requires no credit check at creditgold.org. It's a great account for rebuilding your credit. The second largest portion of your credit score is made up of the percentage of high credit limit that you're using on your credit accounts. So, this accounts for almost a third of your total overall credit score. It's based on your credit limit utilization ratio. Basically, how much you owe on your accounts in relation to what the high limit on those accounts is. Maxed out accounts and high balance with low available credit accounts decrease the credit score. But high amounts of available credit with low balances increase the credit score. Tips to spike your score? Pay down your credit card balances below 30% of your credit limits. This 30% is a magical number when it comes to the credit bureaus. If you owe more than 30% of your high credit limit, your scores will go down. If you owe less than 30% of your high credit limit, your scores will most definitely increase. Request credit limit increases from existing credit card companies. If you have a higher limit, this will increase your score. Sometimes one call to your credit card companies will raise your limit, and that in itself will instantaneously raise your credit score. Add high limit positive reporting credit items to your credit report. Sometimes when you have credit problems, this can be challenging. Again, we've done a lot of research as a company, and the best account we found for credit rebuilding is available at creditgold.org. Why we love this account is for several reasons. First of all, it's guaranteed approval and has a 0% interest rate. Most importantly, it gives you a $5,000 available credit limit. So since a third of your credit score is based on this factor, what percentage of your high credit limit you're actually using, this one account being added results in a significant increase to your credit score because it's such a high amount of available credit. You have $5,000 worth of immediate available credit on your report, and being that this affects a third of your total score, it results in a very nice overall credit score spike. Length of credit history accounts for 15% of your total score. This is the third largest factor in your total credit score makeup. It's based on the length of time you've had items reporting to the credit bureau. High scores, especially over 700, are hard to obtain without having years of credit history reporting with the credit bureaus. Tips to spike your scores? Always make sure you have open and active accounts reporting to the credit bureau. Authorized user accounts are the only way to backdate your credit history. This means it's the only type of account that can be added to your credit report showing many years of previous history. You can have an authorized user account added to your credit report, and this might show 2, 3, 4, or 5 years worth of total history. This will improve this aspect of the credit score. But be careful. The FICO 08 credit scoring model, the newest and most recent scoring model that's most commonly used, will only increase your scores if the authorized user account comes from a family member. This means do not go out and purchase authorized user accounts. You want to ask a family member, such as a parent, brother, sister, grandparent, to see if you can actually be added as an authorized user onto an existing credit card they have. They really face no risk or liability because you're not physically using the card. You're just getting credit for the actual credit history of paying that bill on time. And make sure you only choose authorized user accounts that have positive credit history and that have been open for many years. Accumulation of new debt accounts for 10% of your total credit score. This accounts for 10% of the overall credit score, and it's also one of the lowest portions of what make up the credit score. It's based on how fast you accumulate new debt on your credit report. Applying for large amounts of new credit in a short period of time decreases your credit scores. So if you've ever heard that an inquiry lowers your scores, it is somewhat accurate. An inquiry, if you go to apply for a car loan, for example, might lower your credit score 1 to 2 points on an 850-point scale. But if you go out in the same week and apply for a car loan at 5 different places and a mortgage and a Chase credit card and a Walmart credit card and a Sears credit card, all in a short period of time, your credit scores will definitely go down because the credit bureaus are seeing that you're applying for a lot of credit in a short period of time. Low amounts of inquiries will increase your credit score. So lower amount of inquiries reporting to the credit bureau showing that you're applying for new credit, the higher your credit score will be. Tips to spike your scores: do not apply for too many new credit items over a short period of time. Dispute any and all credit inquiries to have them permanently deleted off of your credit report. The fewer credit inquiries and the less shopping around you're doing for new credit, the higher your credit scores will be. Healthy mix of credit accounts accounts for 10% of your overall credit score. What a healthy mix of credit report items mean is that you want to have a nice mix of different credit accounts on your report. Having too many of any account type will decrease the score. For example, if you have 3 or 4 open car loans, or 3 or 4 open mortgages, or 5 or 7 open credit cards, you will decrease your score. You always want to have a nice mix or common amount of accounts open to increase your score. Tips to spike your scores: have a healthy credit mix. The credit bureaus will score you higher if you have 1 to 2 open mortgages, 1 to 2 open auto loans, 1 to 2 open signature or installment loans, and 3 credit cards. If you have less or more than these numbers, your credit scores will suffer. If you have accounts that fall within these ranges, this aspect of your credit score will be ever increasing. So there you go. Your credit score secrets have finally been revealed. Now you know the actual breakdown and makeup of what comprises your credit score. The largest factor is your payment history, accounting for 35%. Your available credit accounts for almost a third, accounting for 30% of your total credit score. Your length of credit history is 15% of the total credit score makeup. And the accumulation of new debt and healthy credit mix both account for 10% of your overall credit score. Tips to spike your scores: make sure you're always paying your bills on time. Dispute any negative credit items and inquiries to have them deleted off your credit report. Open a high available credit account. Try to open $5,000 or higher available line of credit. We've already done the research for you. You can access one at creditgold.org. Have a family member add you as an authorized user to an existing account. Make sure the account has a positive credit history and make sure it has many years of credit history reporting. Do not apply for too much debt and too fast. Make sure that if you're applying for new debt that you never apply for a lot of it at the same period of time. and have a healthy credit mix of accounts. A nice broad range of installment loans, credit cards, mortgages, and car loans will help you maximize the potential of your total credit score. So now you know exactly what to do to take control over your credit scores. So make sure you follow these tips, register and watch this webinar again if you need to, but make sure you implement these tips today for a really nice credit score increase. If you'd like to learn more, you can always visit our website for even more tips and tools at perfectcreditfast.com. Thank you so much for watching this webinar. I hope you enjoyed it, and I hope you got a lot of great information out of it.